Microchip Technology. So Microchip Technology is a developer, manufacturer, and seller of semis that are used in a variety of applications, from the Internet of Things to motor vehicles and other smart devices and that technologies. First thing that pops up, I hit you square on the face is the low margin. That's a pretty tight margin. But considering the fact that Microchip does operate in a highly competitive sector of the semi industries, tight margins are the norm. By the way, at 4% average, the margins are underperforming the industry of about 18. The industry average is about 18%, so far underperforming the industry average. But you need to consider the kind of business Microchip is. Microchip, it operates in a very highly competitive sector of the semi industry. So low margins are kind of the norm in that sector. However, in the face of this aggressive competition and of course deteriorating market caused by COVID, as we know, it is impressive, and the Microchip has to be commended that it has grown margins. The margins have been growing. Slightly to 2021, but massive increase in 2021. So slight decrease in 2020, but a massive pop in 2021. Okay, so the fact that they kept margins stable, they need to be commended for this. Now, cost of revenue growth has been decreasing at a downward trend. Again, this goes all into the fact that it does operate in a very highly competitive market. So it is advisable, it is wise, and you can see by the performance of costs that you know obtaining a higher return on low costs is is necessary to optimize growth in net income, or to optimize profitability. So again, the high competition, the effects of COVID, you can understand why margins have been declining at such a why the growth in revenue, why the growth in cost of revenue has been declining. Well, just basically to protect margins and um, really not spend what's not needed. All right, now good cost control. You're trying to eliminate the effect of COVID as well as trying to make your product as cheap as possible. To basically starve off competition. Now R&D as well has decreased at a downward rate, same as cost of revenue growth. For the same reasons. You're really trying to reduce your cost of production, the cost of manufacturing, trying to reduce them so that you can achieve profitability, to give the lowest price because you do operate in a highly competitive market to give the lowest price to maintain your share of the market and improve your profitability. Now R&D as a percentage of revenue, fairly stable, fairly stable. Not much complaints about that. Even though you want to reduce costs, you still don't want to lose track with the big boys. You don't want to lose track with your competitors. So the fact that R&D has been stable, that's pleasing to me, considering the market you operate in. So fairly stable spending on R&D. Now the revenue growth you will see is a bit mediocre, especially in 2021. In 2020 it was a negative. We actually lost money, a lot of it. But fairly understandable. Heavy competition and COVID is just wreaking havoc on companies' operations, on the microchips operations. Now, net income has been on a bit of a downward trend for the past 2 years, but it grew significantly in 2021, and this is as a result of course, tightening cost control, even though revenue increased by 3%. But I think, but most of the growth It can be attributable, yes, to the growth in revenue, but also to the tight cost control, to the fact that you're reining in costs. So you reined in costs to protect margins as margins grew, as well as to grow revenue, even though it's mediocre, but you grew revenue as well as you exploded your net income. You grew it by 126%. So tight cost control, increase in revenue, all led to an explosion in growth in um, in net income. Very good. Return on equity makes sense. Um, it it is a bit mediocre, uh, but again, the entity needs to be commended. The fact that it grew not only its margins but its ROE in the face of mounting competition as well as the heavy fixed cost by COVID. So again, expected considering you've got such low margins that your ROE kind of expected that it will follow that. Low margins, but low margins, but healthy financial position. Um, that is good. That is very, very good. So in the face of mounting challenges, Microchip has to be commended that it grew both the top and the bottom line, and it has stable operations. So it grew even in the face of very, very difficult operating environment. Now the financial position. Now the current ratio is way below the industry average of about 2.37, way, way below. I'm a bit worried about that. I'm very worried about that. Um, the same applies for the acid test, which is also below the industry average. Industry average is about 1.88. Um, yeah, like both these ratios, they worry me a bit, because these are a measure of your liquidity. And they do worry me a bit considering you're underperforming the industry. In 2021, you have less than one. So there's an increased liquidity risk in my view on Microchip's balance sheet. The inventory days are on average above the industry average. Industry average is just over 101 days. On average, Microchip is sitting at 116 days, just over 116 days. So very, very worrying. Um, so there has been a bit of a fluctuation, as you can see. To a degree caused by COVID, the fact that you're holding on to stuff far longer than you need to because uh, of the supply chain problems, uh, competition as well. COVID just made everything worse, but heavy competition as well. So that is worrying because reading all of these liquidity measures, reading them all together, you don't have, Microchip does not have enough current assets and enough liquid current assets to settle current liabilities as and when they fall due. On top of that, you hold way too much stock than you need to compared to the industry. So you're holding on to stuff for far longer. Now, holding on to stuff far longer increases the risk of the stock being obsolete. It does burden the balance. It does burden your bottom line because you have to spend more holding costs. There is an increase in holding costs through holding an increased amount of inventory. So this is worrying, from a liquidity point of view, Microchip's balance sheet is not attractive. There's an increase in liquidity risk. It's underperforming the industry average on all metrics. So this to me scares me and it does put me off Microchip. Now the debt to equity is very high considering the industry average 126. So this highlights to me an increase in various. This highlights to me an increase in financial risk. So you know, COVID clearly has wrecked this company. It has wrecked Microchip. Competition as well hasn't been kind to it, but you know the low liquidity and the high debt levels combined with the fact that you've got very low margins, mediocre growth, very low return on ROE, all of that just paints to me a very unattractive company. You know, the financial position is a bit hot and cold. The balance sheet to me is very unattractive. The increase in days, coupled with the current ratio as well as the acid test, all of those underperformance just highlight a very risky company that not really providing me with the returns that I'm looking for, higher than usual debt levels. So this is a no for me. Now, the cash position. All right. I mean, the cash position of Microchip is very, very good. Actually, very good. Uh, Pretty much stable, but in 2021 has been increased significantly. So what this tells me is a company that can convert revenue into cash. So on average, for each dollar of revenue Microchip generates, is able to convert 35 cents, or about 35% of all revenue made is converted into cash. In line with the industry average is about 32%, and Microchip has performed pretty much in line with that industry average. So, so a good cash from operations margin, very good, in line with industry average, that is satisfying. However, the sufficiency of cash flow does paint a bit of a worrying picture. Industry average is 0.84, and on average, Microchip is at 0.28. So it is worrying. I mean, it has deteriorated significantly in 2021 and 2020. So it does indicate that yearly, Microchip does not have enough or does not have enough cash from operations to cover or fund operations. Now, this deterioration and this underperformance can mainly be attributable to the fact that it is borrowing a whole lot, and as a result, it has to pay back a whole lot. So that to me is worrying. To me, it is worrying. It has a decent what is it, buyback ratio. However, P3 is way too high. Industry average is about 40, or just over 40. And here I'm paying just over 55. So very high, considering I could get high performing and better companies in the same industry. So Microchip overall, it's a good company in the sense of, it's protected margins, it's grown margins, it's profitable basically. However, the liquidity risk, the finance risk, and the fact that it pays you a lot of money back in the form of debt, and has to always borrow more because it always has a bit of a shortage in cash flow. I mean, it isn't a cash flow positive situation considering that it does make cash. But I'm just, you know, considering I'm paying what, over 55, I'm paying a PE, getting at a P of just 55, and considering I'm getting not enough liquidity, heightened liquidity risk, heightened financial risk, low margins. Yeah, no, it's not the company.